For the time being, we'll put the spotlight on Niva Bupa. Remember, Yash was just telling us about the numbers. Company's net earned premium is up 19%, but losses have increased. The combined ratio has also gone up substantially, almost 117. Let's take this forward, discuss the trends and, of course, the prospects forward with Mr. Krishnan Ramachandran, MD and CEO at Niva Bupa Health. Mr. Ramachandran, thank you for joining in. So the growth seems to be coming in. That doesn't seem to be the problem. But I want to talk about the operational weakness that we've seen in the first quarter, this increase in the combined ratio. Can you just explain what the factors at play were and why we saw such weakness in some of the internal metrics?
Yeah, no, firstly, thank you for having me on your show, Surabhi. Just to explain our results, I think it's very important to explain the results in the context of the right accounting standard. We've been saying that although it's not yet the statutory standard, IFRS is the right way to look at our company. And if you look at our numbers on an IFRS basis, and also importantly on a like-to-like basis, because there was an accounting change middle of last year in October 1, as you know, that the insurance regulator announced. But if you looked at our results on a like-to-like basis, our GWP grew 28% for Q1 over last. Our retail GWP, which is a big focus area for us, grew at 32% over prior year. That's number one. In terms of profit, if you look at it on an IFRS basis or an INDAS basis, which is going to be the Indian adaptation of IFRS, our profit almost doubled from 36 crores last year to 70 crores this year. And our combined ratio actually improved from 103.9% to 103.2%. Again, the reason I say IFRS is the right way to look at us is because there's matching of revenues and expenses. On the Indian GAAP side, there is noise because of the change in accounting standard. And, it will actually take about 2 years for that.
Mr. Ramachandran, that IFRS, I completely understand, right? So, for example, what it does is premiums that you collect, it spreads it over the life of the policy, right? That's how you're supposed to account for it. Just to give an example for our viewers. But it's not. It'll come when it comes, right? And that perhaps is the right way to look at it, and it'll significantly change how all insurance companies report financials. But on the basis of the reporting standards now, sir, if you can sort of provide us with some outline, yes.
Yeah, it impacts companies to varying levels. For a fast-growing company like us, where there is seasonality, acquisition cost in IFRS gets matched to expenses, right? So there is a difference in terms of how it impacts different company financials. And look, at the end of the day, accounting and insurance accounting is fairly complex. So from a consistency and a like-to-like basis, that's why we repeatedly emphasize that IFRS is the right way to look at us. It is the standard globally. We consolidate our accounts with Bupa on an IFRS basis. So, I would urge you to examine our financial results on an IFRS basis, because that's the accurate reflection of our economics.
Could you give us so you can give us both, right? Expectation on the kind of growth that you will see in FY26, sir. So net earned premium grew 20% for you. What can we expect for the full year, 26?
So, in terms of giving in-year expectation, it's a little early in the year, but broadly, over time, our guidance has been that we expect to grow faster than market, maybe between 5 and 10%, depending on the investments that we make during a particular year. But so that guidance broadly stays the same.
All right. Hi, Mr. Ramachandran. Good morning. Good to see you in. Nigel on this side. Your expenses of management, as you said, they've come down a little bit. But, there was, I think, there was talk of it going to around 35%. Do you think that will happen by the end of this fiscal? That's point number one. And combined ratio, I think earlier you were talking about it dipping sub the 100% mark. Is that possible by the end of this year? What would be the guidance on both these two parameters? Please go ahead.
Yeah, no, thank you, Nigel. On expense of management, the permissible limit to us as a standalone company is 35% plus allowances. If you looked at expenses of management, for Q1, for us, it's 36%, so we're not too far from what the regulatory requirement is, and we've been consistently saying the requirement is for us to confirm by this year, and we will do that. So quite comfortable on that front. On combined ratio, again, without providing guidance for this specific year, steady state on an IFRS basis, we believe a combined ratio of about 98% is what we want to target, maybe 3-4 years out.
So for the sake of understanding and reporting, because as of now, I mean, you're reporting your numbers in the accounting standard that's applicable as of date. So for the sake of understanding, that combined ratio, which is now above 116%, what can it come down to? We've taken your point on IFRS, but we need to understand, as per current reporting norms, what you report today, how much will it come down by? And also your underwriting losses have doubled. There's also an operational loss. So what happened there? And, will there be improvement in Q2?
So Surabhi, again, I want to emphasize that in terms of the underlying business fundamentals, there has been no shift, which is, again, it's important that we separate accounting from economics, right? Because accounting, as I said, has introduced noise also because of the shift in the accounting standard. So whether it's incidence rates, whether it's the severity of claims, all of those secular long-term trends are as we have anticipated. And on a combined ratio basis, we will improve, but not in a position to give specific guidance at this point.
Okay. All right. So we'll leave it on that note then for today. Thank you very much for joining in, and look forward to more conversations during the course of the year. That's Niva Bupa, stock